account for bonds issued at a discount. So I'm using the same example as before, I just don't have room to write the example itself, but it's our $100,000 2-year bond that pays 10%, and it pays it on 6/30 and 12/31. So when we issue the bond, now it's issued at 98. So that means we're issuing a bond payable of 100,000, and so to figure out our cash proceeds, we would go 100,000 times 0.98, and we would receive 98,000 in cash. We've got a $2,000 discrepancy, and that is our discount on bonds payable. Okay, so let's just put this on the T accounts. So we get cash of 98,000. We have our bond payable of 100,000. And notice our discount comes on as a debit. Okay, so far that's not too bad, but now we have to pay the interest. And so what we do is, essentially what happens is that that discount ends up increasing the interest expense of this bond, because we have to pay back just as much money. We have to pay back the 100,000, but we only get to use 98,000. We only have 98,000 to work with. So that essentially increases our interest costs on these bonds. So we say that we amortize the discount over the life of the bond. So let's see how that works. I know you just can't wait. Okay, so what do? We know we have our 6/30 interest expense, and we know how to calculate that. We're going to pay out, we multiply the face value of the bond. Let's see, just do this up here, the 100,000, times the stated interest rate, gives us the interest per year, divided by 2, gives us each payment. So regardless of whether the bond is issued at a premium or a discount or at face value, the amount of interest we pay, the cash out, is always the same. What's going to vary will be the interest expense, because what we're going to do is amortize this discount, the 2,000, over the life of the bond, and we do that by dividing it by the number of interest payments in the bond. So we have a 2-year bond, okay? We make 2 payments each year. So we're going to divide that discount of 2,000 by 4, the 4 payments we make, and we're going to amortize 500 with each interest payment. So how does that work when we say amortize it? Well, we are going to basically go discount on bonds payable. That will reduce it, because you notice it's on as a debit. So we're going to credit the discount on bonds payable, the 500, and that means our interest expense is going to be 5,500. Let's see how this happens. Okay, we paid out the cash. This is our first interest payment. Our interest expense is going to be made up of that cash, but it's also going to be made up of, in addition, the amount of the discount we amortized. Whoop! Oh, get carried away there. So our first interest expense is the 5,500. Okay, let's do the 1231 entry would be the same thing, but let's just kind of walk through it. We know we're going to have interest expense, and because the bond was issued at a discount, it's going to be higher than if it were issued at face value. The amount of cash we pay out is always going to be based on the stated interest rate and the face value of the bond. But we're going to amortize the discount over the life of the bond. So that means we're going to take, 500 each payment, and our interest expense ends up at 5,500. So for each interest payment, we would do the same thing. Yeah, okay, we paid out 5,000 cash, so that's part of our interest expense. And each time we're going to amortize 500 of the discount. So there's our second. And we would do that 4 times. So here's the third one. We'd have the 5,000 interest expense. And we'd amortize a little bit more, and that gets added on to the interest expense. So that's 3. And you see why I like a 2-year bond and not a 10-year bond? Okay, so we've got the 5,000 and the 500. And if you add all of this up, did I not add all of this? Okay, if you add all of this up, you've got 22,000 is the interest expense. Remember, on the one at face value, it was only 20,000. Okay, so when it comes time to retire the bond, when it's you know, at the end of the 2 years, the 2 years has gone by, the bond payable is simply going to come off the books at the 100,000, and we would write the check to all our bondholders for, we would pay off all our bondholders for the 100,000. So this would be what our cash flows would look like on this bond. Okay, that would be redeeming it. You'll notice that by the end of the life of the bond, that balance in the discount is 0. We've totally amortized it over the life of the bond. Okay, I go through a little bit more detail on this on my notes if it's helpful for you to kind of walk through it. You know, do that. If it's not, then you know, I pretty much cover everything on the more detailed part of the notes here. Okay, so our next adventure will be into issuing bonds at a premium and paying interest.